Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, July 29th, just after the close. One of the most overused words in the markets is fascinating. But I'm going to use it today. Fascinating week. Why was it fascinating? Inflation numbers were ugly. Powell, you've got to stretch pretty hard to think Powell got a little bit dovish, yet the market ripped. Why? We've talked about that kindling sitting on a forest floor, dry kindling that needed to just get lit. It got lit. And why did it get lit to that extent? Positioning. People out of position. We've been going over now for a few weeks the short interest in the market, the options being tilted, the premiums being paid for puts by speculative investors off the charts. Those type of trades you have to pay attention to. Now, does that mean you jump in 100% long and so forth? No. But it's information that you must process into your allocation. And that's what you try to do to keep from getting too greedy in big runs or too fearful when the market looks like it's on the precipice of really falling apart. So we keep going back to that June 16th low and how that Monday post July 4th weekend opened horribly, down 1.5%, and a bid appeared in the afternoon, about 2 p.m. Very interesting. We mentioned that Friday. Very interesting. Coincided just above that June 16th low. Just things to process. There's demand at certain levels currently. Does that mean it'll be here a month from now, 2 months from now? No way to know that. Besides the word fascinating that gets overused, because most of the time, week to week, the markets aren't fascinating. But in terms of that term, that overused term, one of the things I found this week that was so interesting was the Treasury market. The Treasury market, which John will touch on in his video, has the 10-year closing out at about a 265. Are you kidding me? A 265. Where is this demand coming from? You know, we talk within the firm about positioning in equities, positioning in fixed income, positioning in the Treasury portion of fixed income. I'm a little bit spooked by the demand for Treasuries here, because we can talk about break-evens on inflation rates and is there a Fed pivot? That's all talk. I have a bit of fear that some of this move into Treasuries, the safest ultra haven in any market, is because there is something happening within the currency or credit markets that aren't right in front of us, that we're not noticing. You know, is it in China with their real estate market falling apart? Could that have some contagion? I don't know what it is. We don't know what it is. But that's an unnatural bid into Treasuries, with the Fed still looking at 2, 3, maybe 4 more bumps. Now, if you're full on in the camp that the Fed is going to pivot and be forced to start cutting rates, I'm going to tell you good luck on that trade. I think that's a trade that people may be getting a little ahead of themselves. So we're going to do what we always do. Not going to get too high, not going to get too low. Going to try to be reasonable with our cash. Going to try to take some positions down into further strength. And one thing that was evident, and just to remain consistent here, we've been fans within the tactical portfolio, U.S. core, U.S. ETF, to some extent, of cash cow positions. We need cash flow. We want to concentrate on cash flow in a dicey market when the market and the economy are fighting between a recession and inflation. Give me Microsoft's cash. Give me Amazon's cash. Give me Exxon's cash. These are the names that exploded this week. That's not by accident. For a little while, they were being dragged down with everything else. But cash flow doesn't lie. And we're going to continue to concentrate on those type of positions. So, heading into next week, listen, with the strength the last 3 days, would not be surprised at all for some backing and filling. That equity market's still going to be very headline driven for the foreseeable future. We have cash. We're looking for reasonable levels. If we continue to get rips further here, don't be afraid to take a little off and reposition. If you felt uncomfortable at any point with your positioning over the last 30, 60, 90 days, 4 months, use a rip to reposition. Whether it's coming out of some areas not trading as well and moving into some more defensive areas, think these things through ahead of time. We're going to toss it over to John, who's got some thoughts on the fixed income market and specifically the Muni market.
Hi, it's John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon on July 29th. This week, bond yields down across the board. Treasury yields down anywhere from 7 to 10 basis points. More in the 5-year bond down about 14 basis points lower. So as you sit here today, the 10-year bond, which is in mid-June in Treasuries, was at almost a 350. As you sit here today, it's about a 265. That's an amazing change in a very short period of time. What's going on? The market is reading the Fed. The Fed this week raised short-term interest rates another 75 basis points. Now that upper target is now 250. It had been at 175. They'll probably do another 75 basis points next meeting. That'll be up to 325 and maybe another one after that and get to 4%. The point is the market is starting to smell slowdown. We know there's a lot of anecdotal evidence of slowdown. We've talked about things like commodity prices, housing, etc. The question is it how much of a slowdown will we get? And, when you look at the fact the Fed still has a lot of work ahead of us to get inflation down, particularly an inflation rate that's cruising at 9% on the headline CPI, and other measures of inflation, even the Fed's own PCE is still tracking much, much higher than the Fed wants. It means the Fed's still got to do more work. We're not quite sure at Cumberland whether the markets are poised for that because it's been a pretty good rundown in yields. Our thoughts were that things were going to slow down a little bit and that yields would probably come down. I don't think we saw it coming down this fast. And now some people are trying to already compute in, if you will, a Fed cut when you get to the end of the first quarter next year. When a lot of people get into that end of the boat where we kind of were, we get a little more wary when the consensus gets like that. It kind of scares us a little bit. So we think the market's been on one heck of a run since really the middle of last month. Let's look at munis for a second. Muni yields this week down about 15 basis points across the board. Really broad drop in yields. And we also had inflows into munis this week in bond funds. You hadn't seen that in a while. We saw it 2 weeks ago, but for the most part, we haven't seen anything consistent. We'll continue to watch it. For us, what was very encouraging in the muni market was the subscription level of the deals that did come this week. Yes, supply is down a little bit, but the deals coming to market are oversubscribed 10, 12 more times. That is so different from what we had just a few months ago, where deals were still coming cheap, even cheaper than they are now, but you didn't have that level of oversubscription. That tells you that the market is fully embracing these 4% yields, and I don't know how long they're going to be around. There's no question the market is more expensive now. A deal comes to market now in the long end of the muni market, might get priced at a 410, 415. Some of those deals were at a 450 just about 6 weeks ago. So does it mean the muni market's turned the corner? Not yet. You certainly can't say that when you can buy 4% plus long muni yields and you have at the same time a long treasury yield that's only at 3. So that market has not fully cured up yet. But what would cure it up would probably see bond fund investors look to see a drop in inflation a little bit. In other words, the monthly numbers start to come down. That would encourage them to start putting money into bond funds, and we think that muni yields would then gallop pretty fast to try to catch up with their Treasury brethren. Next week, we will have the unemployment number on Friday, always a big number, and the jobs number, so we will watch that intently. We think the Fed will be watching that intently as well. So we hope everybody has a good weekend, and we'll talk to you next week.
Thanks so much, Moose. And that's a sharp sweater, by the way. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos, and we'll see you next week.